How are you today? And thank you for making the time to come down to K&L Gates in San Francisco and, talk real estate, which we all love to do. I'm going to start with obviously our sponsor. So Ken Kecskes, thank you so much. And thank you, K&L Gates, to, sponsoring not only Marty, but, this particular portion of the program, which is obviously real estate. When I think about, your background, Ken, as a lawyer, you're a transaction real estate attorney. And I know that, this has been a big part of your career. Tell us a little bit about what that means as a transaction real estate attorney and why it's so important for family offices to work with one.
Well, look, certainly, real estate is very complicated business, and not only from the perspective of developing, but owning and financing real estate. You start from the very beginning of the process when you're identifying a potential opportunity. Certainly you want to understand not only the business side of the asset and what's going to return, but also, you want to do appropriate due diligence on that asset. You want to understand what it is. You want to make sure that you understand how you're going to finance that. You're going to document that financing relationship. And then, as we've talked about, depending on the product type, you're either going to be leasing that asset either to individuals, if it's a multifamily property, or to businesses, if it's office or life sciences, or some of the other product types that we've talked about. And so what's great about K&L Gates is two additional things I'll just add. One is our footprint. It's global. We are in 46 offices, or more than 46 offices throughout the country and across the world. And second, the other part of it is, we just have a really deep bench of people that can provide help with fund formation and entitlement and just your, standard, transaction diligence.
Very well said. And Matthew Bishop, welcome today. And, Olo Capital. I know that, you reside in, if I've got this correctly, in Utah, and that, Idaho and Florida are really top MSA markets for you and your firm. Talk a little bit about Olo Capital and why Utah, Idaho, and Florida are your top MSA markets.
Thank you very much, Matthew. Olo Capital is the genesis. We created Olo Builders, which is a franchised home building company. And as we started going and growing, it started out in Utah, and then it grew into Idaho and now Florida, and it'll open up other markets as well. But we play primarily in secondary, tertiary markets. We'd never be in a San Francisco trying to build. So what it creates is an opportunity to get into some projects for single family homes. And so we have all the technology. The last panel was talking about what technology you have and how do you leverage this stuff. On the home building side, we have absolutely phenomenal technology that I'd put on par with some of the largest home builders in the country. But what we found very quickly is that in these markets, especially when things heated up during COVID, that if you don't have a ramp of lots, you can't expand your business. So we created Olo Capital. So we just launched a small private equity fund for going in and doing horizontal development so that we can have that ramp of lots. And so that's where Olo Capital is doing. And hence I'm here as well, just to look at some of the family offices to raise some capital.
Talk to me a little bit about how you're staffed, Matthew. Talk about, those that are within your company and then maybe those that you outsource to round out your firm, whether it's law firms, accounting firms, technology. Talk about sort of the structure of your company.
We have two primary general partners. Both of them reside in Utah. One founded a business and sold it and has come in and funded the first couple of deals that we've already been working on. But exactly right. We need, great real estate attorneys. Our CPA, again, people who understand fund management. I'm the principal and investment manager for the fund, but it's a small group, and so we need to leverage expertise in the local market. So one, we have our franchisee in the local market, but then two, I need to bring in a developer in that market. So we want to come in and partner with existing entities in these different markets, so we don't have to be everything to everyone.
Got it. Love the background. And Ken Kecskes, I'm going to come back to you. And I know one of the areas that you and the firm are, very interested in is distressed real estate. Let's talk about secured debt that, lenders that want out. And let's talk about, some of the sales that's going on in commercial real estate due to the stress of the capital structure.
Yeah, what we're seeing here in the Bay Area in particular right now is a very distressed market. We're seeing that assets are now trading at sometimes 60% less than what they sold at pre-pandemic levels. And what that means is that that's an outstanding opportunity for family offices and private equity. If you are bullish on San Francisco in the long term, this is the time to kind of enter this particular market and get in, acquire some of these assets. Some of the ultra high net worth and family office folks out there have the patience to be able to ride out this, bump that we're in right now. But if you believe in the fact that, San Francisco has all the fundamentals, it's an innovation economy, VC capital, this is the largest place where VC capital washes around. All of the two major universities, Cal and Stanford here, as well as all the other just innovation that you receive in this area. Those are the kinds of things that provides distressed opportunities, kind of the very simple, buy low, sell high. So this is the time to get in.
Matthew Bishop, I'm going to ask you to pick up on that, and then I'm going to talk a little bit about PACE equity and how we fit into a cap structure. So, Matthew, what are your thoughts about, distressed real estate, whether it's not happening in your backyard in Utah or Florida? But, what's your overall take of what you're seeing out there in the distressed world?
So there isn't a distressed world really in the markets that we play in, and that's kind of unique for us right now is we see the exact, or we're taking advantage of this urban to rural movement through COVID, right? And it hasn't really slowed down. And so it makes for, we've seen maybe a 3 or 4% drop. I think it's more due to interest rates rising. But from that, basically, everybody's charging forward with the real estate market because they need to live. The COVID and actually the Great Recession 2009 created this huge undersupply of single family homes. For a time, there was about 5 million shortages of single family homes and apartments for the United States. I think now today there's about 3.8 million. So the market is still in demand. And as soon as we see interest rates tip back down a little bit, or we see them level off, we've seen just in the last 3 or 4 months, the number of appointments coming in to buy homes has shot back up dramatically. That December, January timeframe, everything kind of like just dried up as significantly, but now we've seen the market come back.
Well, I think I'm going to start the capital markets discussion, and then we can, swing back to you, Kecskes. I work at PACE Equity, and PACE stands for Commercial Property Assessed Clean Energy. It's a financing tool. We belong in the cap structure. It's gap financing. But we're seeing new construction rates very high if you're a builder. We're seeing lumber prices, running around 351. So the reason that, I think right now is a nice time for PACE Equity and our firm is our financing is 350 basis points over the 10-year. That's it. It's 30 years. It's fixed. It's, type of financing tool that works well in any type of an asset class, cold storage, engineering, grounded our firm, construction, development. We just bring a lot of tools to the table. So, Kecskes, let's talk about the capital structure. How tough is it to find equity? How hard is it to find construction loans or just pure debt out there? Well, what do you see?
It is hard. And again, this is another opportunity for family offices and ultra high net worth individuals to put together either debt funds or established debt funds on their own. Because what we've seen is, particularly since Silicon Valley Bank, is the regional banking system stepping back from providing construction financing, from providing, real estate secured financing on properties. Yes, that's still happening, but at a much reduced rate. And so for private equity and ultra high net worth, establishing a debt fund allows you to provide not only bridge financing to fill the gap until commercial property owners want to go into the next step of the situation where they're able to, get back to the regional banks, or perhaps longer term financing. And we're seeing that money come in not only from here in the United States investors, but also from investors abroad. I was talking this morning about with some Chinese investors who are establishing a $200 million debt fund. What are they going to use that for? They're going to use that for filling that gap in the capital markets right now for multifamily construction, for single family build for rent that they're looking at doing. So there are people, raising funds right now that see this market opportunity in the debt markets that caused by the dislocation of the interest rates increasing and the blowback, so to speak, or the punishment that Silicon Valley Bank endured.
Right now at Pace Equity, we've got
Sure.
about $1.4 billion of powder, meaning we've got $1.4 billion
Matt,
of
Marty's got a question. I'm sorry.
Marty, go ahead.
So it's not just the regional banks, right? I mean, it's the community banks have also dropped lending. The regional banks have dropped it, and a lot of them are selling their portfolios because of the exposure. Is that right?
That's correct too. And you want to add something?
So maybe address the spreads that we're seeing from the funds versus the banks.
Well, I was going to say personally, from the projects that we've been working on, Marty, we're hitting lending limits from the banks. And so they've already got so much assets into this type of real estate. And so the board and the bank is just basically saying, stop, you can't lend anymore to this. So we've had to switch banks, going from one of our longtime banks to a different bank, just because we haven't been able to get the loans that we need to do for horizontal development.
So it's like LTVs for like 75% and now they're 50%, or?
I'd say 80% down to 60%.
And I think what Matt's saying is part of it is like it's basically like a regulatory issue in terms of how much of a bank's balance sheet can be committed to real estate. And right now, just because of the uncertainty in the market, there's just a little bit more reluctance about, well, how much runway do I really have to be able to invest in real estate assets? Not saying that they can't. I'm just saying that there's less runway available, and they're being more prudent about which customers they're going to serve. So that's one issue. And again, it's an opportunity for private equity and ultra high net worth. But in terms of
That was my second question.
Yeah.
What's the spread on?
Yeah, the spread, I don't know Matthew, you might know a little bit more information about the spread issue
Sure.
and where that is.
Well, I can tell you, I'll speak to Pace Equity. For us, the spread issue, if we're going to be making loans, is we're 350 over the 10-year. So we just look at the 10-year and, our loans are 30-year and we're 350 basis points over. So it's pretty easy for people to think about us.
Yeah.
Sign me up.
And our current dry powder is about $1.3 billion with balance sheet lenders. And we just went out and raised a fund for $400 million. So we're flush. So, as a firm that's in commercial property assessed clean energy, we're part of that top structure. So I think what I'd love to hear from Matthew is, we've had 10 interest rate hikes since March of 22. How slow has deal lending been, for new construction?
So I'll address that more from the consumer. So most of the homes that
Please.
we build are third-party builds for a consumer. And so if you look what happened, interest rates in 2009 were at about 5.25, a little less than that. Now we're 7.25. So when they got above 6, it just killed the consumer market for new home construction. It just almost shut down. And then finally, I think it was the uncertainty of inflation, uncertainty of recession, got to a point where in December it was almost completely shut off. And it was more from the consumer not wanting to proceed forward versus the bank not wanting to lend. And now what we've seen literally is the markets back opened up, and we track on the builder side. We have marketing for all of our franchisees that we provide, and we're at record level numbers of appointments that we set up for each of the teams. So we're actually seeing the market just be as robust as it's ever been. The issue is because the rates are higher, they're qualifying for a less of a loan, hence a smaller house or not as nice amenities into the house.
So Kecskes, let's move over. Oh,
Your core focus is on Utah, Florida, and Idaho,
Idaho.
right? And those markets are highly deregulated, unregulated.
Highly unregulated. It's it's totally different than California. I grew up in Danville, across the bay. Raised here, lived here actually before we moved back to Utah. It's just a whole different world. And we maybe talk a little bit about master plan communities and large developments in the areas that we were operating. It doesn't exist because the farmer essentially owned maybe 20 acres of land and had a small farm. And so now the dad is passed away and the sons don't want to farm anymore. So they're selling these small plots of land. So all these developments are small developments of maybe 25 to 35 homes because the regulation is, half acre lots or quarter acre lots. And so it's a different market, which takes people to be able to be nimble to go in and work well within that market. And the nice thing is we don't have the same competition. You don't have the DR Hortons. You don't have the, top 10 builders in the country competing for driving up the prices. So.
Matt, Ben Kecskes, I know you and I have talked a lot about life science, and I know that, at K&L Gates and your own practice, that life science has been something that, behind the scenes, you've been doing a lot of work in. Talk to the family offices out there about life science and sort of your work at K&L Gates.
Sure. Thanks, Matt. So look, there are in the San Francisco Bay Area because it is one of the innovation economies, because we have such a strong base, particularly in South San Francisco in the life sciences area and in the two educational systems that I mentioned earlier. We're on the cusp of a wave, so to speak, and for demand for life science space. And, as Camille had mentioned, we're one of the top three markets, right? Boston, the Research Triangle, and San Francisco. And so there are sponsors today that have entitled projects that are shovel ready for life sciences construction that will have end users. Sometimes they'll be large companies like your Genentech or your AstraZeneca, or sometimes they'll just be the folks that just got their PhD at Stanford and now they're ready to launch into starting their own business in you name your genetic biology business. Those opportunities are looking for private equity, high net worth individuals to invest in those real estate projects. And the benefit is that those real estate projects, once they're developed, because they're so capital intensive and require, the kind of infrastructure in them, those businesses, are going to stay in them until they outgrow them. And so, you've got a stable tenant in a growth industry. And so it's a great opportunity. So for us at our firm, we represent a lot of life sciences companies, and then also, in addition, sponsors of those life sciences real estate asset.
Yes. Talk about some of the joint ventures, Ken. I know that joint ventures with sponsors in life science facilities are going on in the Bay Area. What kind of JVs can you tell us about, or at least tell us some of the stories?
I just wanted to just kind of jump in the same question.
Yeah, same question. Okay.
It's similar. We saw some companies that were like WeWorks of life sciences. Are you seeing that as well? And does that help anything in terms of scale, or
it's
like shared life science space?
Okay, I wouldn't say it's necessarily like a WeWorks. It's more like
some life sciences buildings constructed for, let's say, a couple 100,000 square feet and to a single end user, right? And so there are folks that are doing that, right? They'll build the building and we know companies like that. And I'm sorry I can't get into specifics because, of course,
Sure.
attorney-client confidentiality. But there are name brands, so to speak, real estate owners, as well as up and coming real estate owners in the Bay Area that have seized on the opportunity, that are identifying locations here, whether they're in the East Bay, near Berkeley, or they're in the South Bay, near South San Francisco or San Mateo, or they're here in San Francisco, right? And, I know that I guess it's Tishman. Spire also has some product that they're trying to work on at the site right across from the ballpark, so that's for lease, by the way. That's for my friend there. Anyway, so but there are those kinds of opportunities that are out there. And again, the opportunity for family offices, in my view, if you're not going to invest in the companies themselves, is how can you partner with some of these sponsors that have already seized on the entitlement opportunity and they're shovel ready, and they just basically need help with the project equity going forward.
So, Matthew, let me come back to you. I know something you and I have talked a lot about, which is supply chain and labor. Talk about supply chain and labor going back into COVID, and how you see the asset classes that are attractive to Olo Capital being impacted by supply chain and labor. So go back 2 years and tell us where we are today.
So I'd actually like to start, if we look at a chart, maybe go back 20 years, 30 years. If you look at the average home increase year over year, you probably have somewhere between a 10 to 12% increase if you look at a curve kind of like this, and it's just a nice general growth. As soon as 2020 hit, it turned to almost like a 60% growth of home prices. It was driven by a couple reasons, really. Demand. Everybody was moving and buying new homes. Two, the supply chain just absolutely crushed everything. Even today, I was having my own appliances worked on the other day, and the guy said there's a 2-year wait for Sub-Zero appliances. So this is today, not 2020. Lumber prices, Matthew mentioned they were about $350 now. And the height, when I was, of course, building my house, I was paying $1,500 a board foot, 1,000 board feet for lumber. So the not only was the pricing just shot up, but also then all the subs, the framer, the plumber, the electrician, their hourly rates or however they charge for their services doubled as well. So you have the compounding issues of price increase from the material, and then labor increases absolutely just drove up the average home price in the market. It's to me, it's just a phenomenal graph to take a look at as you see this nice general thing, and then COVID hits and it goes like that. What I think is going to happen in the future is we've already seen lumber come down. With the impending recession that's going to hit here shortly, I think what we'll see is we'll go back to that kind of 12%, 10% growth for here on out unless there's some other kind of black swan event. But I don't see the housing market really dropping, though. Yes, sir.
So you're no doubt familiar with Kessler, and the index goes all the way back to 1880. And if you look at that, he has an index starts at 100, it goes as high as 120, goes down to 80, I think it got up to 140. So in the end, it seems like there's some markets that can go up a lot where there's real restricted building supplies and stuff like Monaco or parts of London and stuff. But in the normal case, who can buy a house if it's going so far expensive as faster than the GDP? It seems like that at some point in time it'll revert to the mean.
I think it's a great question, and let's just take a look at the San Francisco Bay Area housing market. I mean, when has it ever really reverted to the mean other than 2009? I don't know of a time when it's come back down. My house here had almost a townhome type of thing. I paid $1.5 million for when I sold it. My house in Utah is 4,600 square feet in the mountains with a fantastic view, marble, blah, 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 blah. And it's $1.1 million. So I don't really know how to answer your question other than the fact that people somehow seem to afford, whether it's through financing. And actually, it's a really interesting comment because when I moved to Utah, it was right at the cusp or the early stages of COVID. And I realized that these 20-some, this is Mormon land, right? I'm not LDS, but these 22-year-old kids had 3 kids and a wife, and they lived in a nice house. They ended up working for dad. The wife stayed home. The dad paid him a decent salary, put a down payment in for him, and they could afford a $350,000 house. That house now is $650,000. The whole dynamics for how Utah has changed. Now either the kids are renting or the husband and wife are both working. So it's changed the dynamic. And here, you think back, my dad worked, my mom didn't work. And we had a nice house in Danville. So today, pretty much it's all dual income. So they're trying to find a way to increase your personal GDP.
But you think
Nice.
over that still holds?
I think so. I mean, either that or the whole economy kind of craters.
I think there's an interest rate issue going on.
Yeah,
Or,
yeah.
I mean, and I think our first speaker said that if it's say the 4.5% inflation, the Fed's going to do something to really stop that and get it back on a 2% inflation.
So I bought my house in Los Altos Hills, which is the home of billionaires, although
Yeah.
Osaka's aren't one of them. And for $500,000 in 1982, at that time that was a lot of money. Okay, today it's worth about $6 million. Or maybe it'll be 7 when I build the ADU. If we ever so that on an unleveraged basis is, yeah, I know. And Marty wants to be the first guy to stay in it. But, so that's about a 5% return. And I got a guy behind me that just bought the last lot. He's got $5 billion. Now maybe he'll pay me a little bit more than $6 million, but I don't
So
want to sell
Ken
it.
Kecskes, let me ask you a question. You and I talk a lot about regional banks, and we talk about Silicon Valley Bank, and we talk about Silvergate Bank, and we talked about
Yeah.
Signature Bank and the sale of PNC Bank. Among key lenders, I think in the commercial real estate sector, are there more challenges ahead? And how does K&L Gates help a family office circumnavigate those problems?
Well, there are definitely challenges out there, and Gary, I don't know how to, answer your question other than to say that one of the key components of and I'll get to your question, Matthew. One of the key components is labor and all of this stuff, and that's just not going to go down, unfortunately. At least in the Bay Area, the labor costs aren't going to go anywhere, but either stay the same or go up, except for maybe in if we really hit a huge bump, and we'll see what happens. But it's really just materials, and I think the only material, and you can probably confirm this too, is lumber. That's fluctuate a little bit, but much of it is and concrete too, maybe a little. But the costs are the costs, right? And city governments and state governments just keep adding on additional impact fees over and above. So that's why we have a housing affordability issue. And for that reason, that's also a key need. And I see a hand up.
I look at a company right now that is doing certain things on building materials, where the building material cost, which is more malleable, the whole bit. So the building material cost they see are coming out are ESG friendly, and also are coming down to like 1/3 to 1/2 to 1/3 of the cost of the lumber and the siding and everything else that's coming in here. So I kind of see that in the future, on about a year and a half down the road, the manufacturing plants kind of come up to speed on this stuff, that the building material costs will come down also. So,
well, certainly that's one thing, right, that could drive costs down is innovation in building materials, making things cheaper and faster, right? And that could be a way to solve it, and certainly people are talking about 3D printing houses and how that could potentially change costs. And here in the Bay Area, we have a company called Factory OS, which is a modular company that's in Vallejo, and they are trying to, use different models to reduce the cost of construction. So those kind of innovations could potentially reduce costs, but there also is some reduced risk. And I know you're reaching for the mic. Sorry, Matthew, we'll get to the bank question.
Just to that, be a little careful because the subs have to be able to know how to install that. And what happens, I'll give you an example. My sister's building a house up in Carson, and she's using SIP panels, which are basically 2 pieces of plywood with the studs already in it and the insulation already in it. So it's supposed to be faster to build. She can't find electricians to know how to work with it. The framers don't know how to use it. Nobody knows how to use it. So these great technologies, which are being invented and do exist, unless it's a widespread usage, then it almost sits on the shelf.
Hand up.
With example, San Francisco downtown office building vacancies over 20% right now, unheard of. What are your thoughts on conversion of some of these buildings that have the right footprint and infrastructure to be converted to residential use?
That's a good question. And so there's been a couple of studies done within the last year about the number of buildings in San Francisco that are eligible, that are current office buildings, conversion to residential. Those studies determined that about 6 buildings in San Francisco were actually eligible because of the way that the footprint is laid out, and also because of the cost that it will take to convert them. So there's a very, very small number that are eligible for conversion. Now, Camille had mentioned conversion of office to life sciences, and that is a possibility too, but also expensive to do. But it is, again, a possibility to take care of that. The vacancy rate in San Francisco is actually over 30% now, so it's really, really high, unheard of. And I was talking to a group of real estate folks at lunch today, and the comparison was in part to the 2001.com recession. Was there some parallels there that we could learn from? Maybe, because again, there's a kind of some tech aspects to what's currently happening. And then another person mentioned, well, maybe this is actually more like 9/11 in New York. And what do we need to do here in San Francisco? Because, part of what's paralyzing people, in addition to kind of the work from home part, is the public safety issue, right? Let's just call it what it is. And how do you make people feel more comfortable coming back to the city, whether it's real or whether it's perceived? It's happening, and people are getting on transit, which is important to the way San Francisco works, to come back. So all these things are going to get figured out over time, but that's some of the issues. Yes.
There's also an underlying health issue here in San Francisco more than any other city, where people are saying, I can go to the city and catch COVID from around people. And it's still here. I've had 5 people cancel coming today because they got COVID in the last 3 days. Yeah. Oh, geez. So I mean, it's something that people really are conscientious about.
They are. The people are very conscientious about that in the Bay Area, and it is something to be mindful of. And, all I can say to that is, sometimes it just comes in waves, right? It's a public health thing. You just can't even control it, but you're living in a very dense urban environment. And whenever you're living in a city, you might run into people. And COVID's going to be with us for a long time.
Traffic problem.
And the traffic problem.
Been eccentric for a really long time, but it's never been like this.
Yeah. We'll leave it at eccentric. Yes. Look. I think this one of the things that makes this city so exciting and vibrant is that eccentricity.
Colorful.
All right. And all of that is what really makes San Francisco what it is. And it provides a setting for great innovation and freedom of thought and all that stuff, which is very compelling. But, we have these externalities that we're dealing with. There have been changes, but not necessarily fast enough.
Okay,
What
so
about Silicon Valley Bank?
we have
The
another
question,
question.
back to the question. I think what I'll say is, we have a full team of lawyers here at K&L Gates that know how to deal if there is another shoe to drop. I think within 48 hours or even less, I was 24 hours after the Silicon Valley Bank was announced that it was going to be failing, or the federal government released that, our firm was all over that. We had a video, webinar with specialists that worked within, perhaps the Federal Reserve Bank or on, Senate and House committees, folks like that are here at our firm that know how to deal with that, how to advise clients whose money is locked up. And I was reading an article actually about some folks whose, I think it was, I don't want to get it wrong, but one of the banks, the FDIC guaranteed all the depositors that were U.S. persons, but not the non-U.S. persons in an offshore bank, and I think it was Cayman. And so those folks didn't get their money and are still have a contract obligation to pay the debt to the bank. So you can imagine they're feeling a little bitter because their deposits weren't safe, that were supposed to be the collateral for those loans, and now they have to pay the loans. So, but we have people that can help with that kind of stuff.
Only in America.
Only in America, yeah.
Only in America.
It was SCB.
Matthew, you got a question?
Couple questions.
Sure, go ahead.
Yeah, I just wanted to throw this out there because we had the comments about housing prices and stuff, but I have a family office I'm working with who's a prominent home builder, and it just brought up an interesting concept because they firmly believe in the upcoming, if not this election cycle or the next, that the topics of rent control and government affordability will move from the private sector and it will become a public sector issue. And they were pretty interested on seeing how that will play out once we see government regulation coming in on either capping rents or trying to cap prices. And they see that as the next realm of, or the next potential shock to come in to see what could potentially go right or wrong with that change. So I'm just interested to see if you have opinions
Is that
on that.
fundamentally you're saying in California?
In California, but they think it's going to get to a national level, or specifically for rent and rent control with some of the bumps people have seen here with growth.
California has, I'll hand it over to you in just a second. California does have statewide rent control, and other states are considering taking that on as well. So that is coming, and California is often a barometer of what's going to happen in Washington, because a lot of the state government officials and bureaucracy here moves there at some point. That's what you've seen with a lot of the green laws. And so you're going to see a similar, potentially a similar thing nationally, especially in markets where housing affordability is really tight, and the majority of the MSA, as Matthew keeps mentioning, is made up of people that are in that kind of affordability gap where they're not eligible for the traditional affordable housing programs where you have to have a really low income, and then they don't have the money necessarily to buy the fancy house that Gary lives at, but they're in that middle, and so those are the folks that are going to need to be helped.
But I think you're missing one point. The New York mayor came out a couple weeks ago and it says, we don't want the undocumented aliens. I don't know the political correct.
They're called migrants.
Yeah, migrants. Those migrants
Undocumented
space in the hotels. We want to tell people who have an empty room in their house that you've got to take these guys, and of course they're going to pay them some money, but maybe not me. So I think that you're going to get to the next stage that basically says, hey, you got a big house like we do, although we use every room. You've got to take people that can't get any housing. I think that's the next step. you know?
I hope not, and thank
Well, I
goodness
hope
we have a
not, but-
Fifth Amendment, but that would be essentially like a taking, right?
You want to bet on
Um,
how many years before that would take place?
Well, in New York, I don't want to bet, but we'll see. I'm sorry.
No,
that's work.
Yeah.
working.
We have more questions.
Anyway, back to that. I think it impacts from a builder perspective, unless the government's going to subsidize the builder, that it's going to shut down growth in those markets where there's rent. I mean, I guess San Francisco would resolve its problem with the 30% decrease in office rents because they'd convert them all to housing or something to that effect. There'd just be no way that any of my peers would say, oh yeah, let's go build in rent control where we can't make any profits.
Yeah, I might
Just-
add that on, just, commend you as a relatively smaller builder, but when we to parlay that with these debt problems we have, we see companies like BlackRock who can solo fund 1,000 unit BTR construction, right? They don't need a bank. And it's really, how that's going to affect the industry. We'll see how it plays out, but in terms of the supply and demand and competition in the market.
Even though they bankroll it, they still have to pay the builder to build it. And if it doesn't make sense financially, even BlackRock's not gonna proceed forward if they can't get the rent out of it. So I mean, it's just it'll stifle growth.
There's a number of communities in the East Bay. I used to live in Danville, and they've gone to a thing called an ADU program.
Sure.
If, for example, if you have a half acre or more, you can build a single ADU. Originally, it had to be for a relative. Now it can be for a tenant. So that's, a possible solution, but what it's doing is it's potentially urbanizing the suburbs. And renters treat a property different than a homeowner. And so that dynamic is challenging, but it's out there and it's occurring right now, particularly in Walnut Creek. I'm seeing it a lot.
But that ADU in Danville is going to be a high rent.
Yeah.
Right. I mean, so we're
Right.
not solving any problem of
Right.
low rent and rent control in this kind of issue, just density issue.
And that is basically, it was a new state law. It was passed that allowed you to basically get an ADU or build an ADU on your property by just pulling a building permit. Whereas before you had to go to your planning department and you had to get a discretionary approval for all that. Not the case anymore.
And if you had to go within 100 yards or whatever the rule was of your neighbors, and they got to weigh in.
Yep. So all of that has changed. Now there's, you can't build another mansion necessarily, but there is this ability to have an ADU, and that's the open question is whether it's going to how it's going to affect housing affordability. And I think, Matthew, you're right. I mean, at the end of the day, in a community where like Danville, you're going to see, very high rents.
Is there another way to look at this? And I like to look at it in different ways, which is like on a macro level. We're going through a period of slower growth. How does housing do in slower growth periods? Or just real estate in general?
Yeah, real estate typically is an inflation hedge, right? Which means you can buy and you can feel relatively confident that you're not going to necessarily lose your shirt, because over time you're going to recover that money. Because if you look at the trend lines that, like the Kessler index or something like that, you're going to see that the replacement cost of real estate is protective.
Yeah, if you look back, it's called FRED data. It's the Federal Reserve Economic Data, St. Louis office or whatever. You can pull up a recession and housing, and they show the recession. And as soon as every recession hits, you see a sharp decline in real estate values or home sales, excuse me. Because of the recessionary, but then as soon as the recession ends, it takes off and goes back up again.
I actually mean real estate growth. I mean, you're building, right? So I mentioned that real estate growth really takes off during, it's either federally subsidized or else, during low interest rate periods.
Yeah, lower interest rate
periods really nullify real estate growth. I mean, you just
Absolutely.
talk to the builders out there right now, and they're like, how do I fill this gap?
Right.
And part of it is just the reality that we still are at a very supply constrained real estate market for residential for sure, right? We just have too few housing units for people that are chasing them. And that's one of the reasons why pricing is so high. And that's why if there is any dip, so to speak, in pricing, it's going to pop right back up because we just don't have enough housing. And, that's why, at least here in California, the state is, set up a unit to sue cities and counties if they don't build enough housing. So there's someone looking over the shoulder of those people. And because of that, it is an opportunity for people in the residential space. The problem is it just takes a very long time to get stuff entitled here.
And like in any market, when there's a shortage, you're finding ways to entice the home buyer. So a lot of builders are either offering additional amenities within the house at zero cost, or they're just taking a smaller margin to keep the churn going, to keep overhead on, lights on. You're up, Matthew.
Oh, I'm back. Okay, cool. All right, so I guess this is for the two of you.
Sorry.
You're doing a great job moderating this panel.
Hey, I love the Q&A from the group, so thank you. I think to stay on the same theme, let's talk a little bit about demographic mobility, right? That's just a measure that measures migration within a population in a teleshopping and telehealth and, teleworking and online learning and conferences like this. How is that going to affect real estate values going forward? I think that's just sort of a jump ball question.
I'll take the first jump and swing at it. So look, in San Francisco, what we've seen is, certainly leisure hospitality has improved, but not as much as I think some folks have wanted. And that's why we've had some hotels that were recently in the news that were basically the owner turned back the keys to the lender and said, you can have it. And conferences certainly have returned to San Francisco. And the AIA conference was here. That's the American Institute for Architects just a few weeks ago. And that was, very successful conference for the city. So, I think we're moving through a transition period, so to speak, in cities like San Francisco, where sometimes things are good and we've got full hotels and full hotels, and sometimes we don't. And with respect to other kind of service offerings, you mentioned telehealth and stuff like that. I mean, certainly that's going to change the need for medical office space, but not totally, because people sometimes, in my opinion, still want to go in and get their knees knocked.
The only thing I'd add to that is that when I look at a development, I just make sure I'm installing fiber. I don't even care about phone service anymore, but I need to make sure I'm installing fiber so everybody can have at least, a gigabyte of data, so they can do these things like remote work, telehealth, et cetera, and be able to do that. It might be a short side of mine because the old twisted pair allowed you to communicate even when the power was out. But I don't think most people even buy a telephone service anymore other than their mobile. So just a cost to me as a developer that I don't have to expend.
And Matthew, let me just ask you a question concerning, building. Do you think you're going to see more builders like yourself and those that are building houses or even apartment buildings designate an area in the apartment, in the condo, in the home that's really just for telecommuting? Do you think they're just going to say, okay, this room is the tech room, telecommunicating, big screen put up there, all of the right fiber coming in and out? Do you think rooms will now be a little bit more designated versus haphazardly on our laptops?
I don't think in an apartment complex, I think it'd be prudent and wise if that type of a builder to go ahead and create almost a business center that has multiple offices, et cetera, so that you can rent a one bedroom apartment, get away and go down into an office and have some functionality and work and then have that kind of connectivity. But those people are still going to want to have the gigabyte so that they can stream the movies and play the games and do whatever they want. I've got a 25-year-old kid that still lives at home, and I'm trying to kick him out every day. And he's on his computer gaming and eats up my internet. So So there we have it.
Marty?
So I don't, yeah, my food. So man, maybe I'm wrong, but I don't see it becoming centric to a specific room. You get a gigabyte of internet and then wireless throughout. You pretty much are covered with the services today. I just don't see it becoming I think it's more important to have a space where you could have a conference or get away from your home and have a more professional Zoom meeting or something to that effect without having some fake background like you have right now.
I think your spouse needs to be telecommute.
You want your spouse to telecommute?
We're not going to touch that one. I just want to, I'll make one quick one. It's a real great irony of the world that, somebody like Matt, because we have this ability to have distributed workforces, right? People don't have to be in San Francisco. They can move to Utah, which is a great place, or Nevada, or any of those, Texas, and it's a distributed workforce. So the only reason why they're in San Francisco is for
This conference.
no, but just some reason, right? There's something that pulls them, right, to be in San Francisco, to be in New York, whatever, which are highly regulated areas where it's very difficult to get household housing, significant housing for your children, et cetera, et cetera.
Family, I'd say family is a big draw.
Well, it's that plus, like I said, the hundreds of billions of VC capital is here. And so if you're starting a business or you're incubating a business and you want to meet with those folks, they want to be face to face with you. They want to know your team before they make their investment. So that's why people come here is that. And then also the intellectual capital, the smart people that are all come here because of the great universities and the innovation economy.
Marty, you can't replace face-to-face, and human interaction. And then if you go to the different places, that's what New York is about.
90% of Silicon Valley startups have tech workers in Croatia, India, Philippines, China.
Somewhere, and they move here, right? And they
Yeah,
capital.
I'm just saying, you do have a distributed workforce. People don't have to be here; they can be other places, et cetera. But I'm just saying it's a great. I said it was ironic. I didn't say it was a must. So anyway, question.
This is a trend I've seen very lately in the residential side relative to rooms that are become essential now, and that is the home office. And also, 5 years ago, CPAs were very hesitant to allow you to deduct that. They said it was a red flag for audit.
I think it still is.
Today, it's pretty much, even my CPA is very conservative, allows me to do it the last 3 years. Prior to that, he said, don't do it. So I think having a home with a home office to it is a plus when you're reselling. I don't know what your thoughts are.
Really interesting.
No, I just want to say one thing. First, I want to say, Marty, forgive me for being bullish on San Francisco. It's just because I work and live here all the time. So that's why I'm a big advocate.
The irreplaceable benefits, there's no doubt about it.
And so, and to your question, I'll just say this, and that's, look, home office is essential to have. I mean, whether there is a tax impact or whatever of you having your home office and running your business, that's beyond my world right now of what I do. But certainly there is a need for people to either collaborate either on the screen here like this or in small groups and teams as much as people think that they can do it over Zoom. That's just not how, creative destruction happens.
To say a dedicated home office, I don't know if that's so important. Is it just another bedroom?
Or it could be a space.
But at the end of the day, a bedroom is a space with a closet. And when you're selling a house, everybody wants an additional bedroom, especially in Utah, because they got 10 kids. So, you think of it differently. 10 kids, 7 bedrooms, and 2 bathrooms. So I just don't know how they ever get showered in the morning. I don't know. They just stopped. It used to be a federal crime, and it's now a misdemeanor. So they reduced the law there. So
We're going to strike that from the transcripts.
oh yeah.
And any other comments, please? Matt, you want to close it up?
All good.